Hello and welcome back to All Things Money. I'm your host, David Blain. We thank you for joining us for this segment today. If you missed the first segment, head on over to our website, dlblain.com. There you'll find information about myself as well as my firm, but you'll also find the archive copies of the show. We were talking about finishing up the topic of who is the middle class in America, and it's a very revealing study and information. I hope that you'll listen to it. We also talked about it last week as well. What I want to start on this segment is talking a little bit about, besides using annuities as a punching bag, another one of my favorites to use as a punching bag is hedge funds. You know, the majority of hedge funds out there are just a way to transfer wealth from the average investor. Well, I shouldn't say average. To invest in a hedge fund, you need to be what's called an accredited investor. Now, just because you've accumulated $1 million or $2 million does not mean that you're smarter than everybody else. And that's the problem with hedge funds, is they're accredited, and so they assume that you have this level of knowledge, that a sophisticated investor, that you can invest in hedge funds. Well, the majority of them have enriched the hedge fund managers significantly, but have not made a lot of returns for the actual clients. There's a lot of reasons for that. Maybe we'll do a show on hedge funds. Today I want to pick on someone in particular by the name of John Paulson. And John Paulson is, I talked about this several years ago on the show. John Paulson, back in 2006, 2007, was betting against the housing industry and the subprime, and he had this, he was an unknown entity. He actually worked for another hedge fund and went out on his own, and somehow or another was able to, you got to read his book, The Greatest Trade Ever is what it's called. And it's a fascinating story, and this is not a personal vindication of Mr. Paulson, because he you know, there's some great lessons to be learned. But anyway, so he bet against the hedge funds, and I think he made, I don't know, $5 or $10 billion in 2008, and another $5 or $10 billion in 2009. Of course, he did this with a very small number of investors because people thought he was crazy to bet against housing, and by the time everybody figured out that it was kind of unwinding, to invest in it, the profits weren't there. You had to be really early. So he was, and as typical, people think, oh, there's the guy that, you know, he knows, he's got the inside secret, and you know, he's got the crystal ball that works over here, and so people started giving him all this money to invest, and he set up these other hedge funds based on his latest, you know, ideas. And one of them, the one I want to talk about today, is gold, and his gold hedge fund is just doing absolutely awful. He has a $19 billion hedge fund firm called Paulson and Companies, and he told his investors in a letter dated March the 6th that his gold hedge fund was down nearly 26% so far this year, tumbling almost 18% in February. And this is a tremendous loss. If you know anything about the markets have been up rather nicely this year. And the majority loser in this has been his gold fund. The gold itself have dropped about 5.1% in February, and gold mining stocks dropped about 10%. But these hedge funds, they use a lot of derivatives, they use leverage, they use futures, options, derivatives, and things like that. And so he's been making a levered bet, you know, margining, borrowing money to invest in gold. And so when gold goes down, the losses are significantly magnified. And so both on the metal itself as well as gold mining stocks. He says that in his letter that, you know, we believe in the long-term outlook for gold and gold stocks, but his other funds are up 4% through February. His merger and arbitrage funds are up more than 3%. But the firms Advantage and Advantage Plus were down more than 2.5% and more than 3% for the year through February. I don't want you to get wrapped up in all the numbers. I know it's kind of hard to see. But the point is that these hedge funds have been doing awful, absolutely awful. And part of the thing that I try to stress on the show is that if someone claims to have, the secret or the magic answer to make a tremendous amount of money, they're absolutely wrong. That the basic principles of, diversification, long-term view, don't get caught up in a lot of prediction type things. Those are what how you make money. Now, certainly, if you own a company or go out and build something, that's a different thing. But if you're investing in the public markets, just like this, he made a huge bet on mortgage-backed securities back in 2008, and it worked out right. If you read the book about him, you'll see that before the bet worked out, he was scrambling. He had tens of millions of dollars of interest payments to make every month because he borrowed money to make these investments. But, so then he went out and he started these hedge funds, and he's been losing a tremendous amount of money on these hedge funds. And so I just want people to be cautious. Number one, if you're invested in these type of things, be very careful. Make sure you understand what you're getting into, and that the hedge funds are not some sort of panacea. And number two, if you don't have enough money to invest in hedge funds, don't worry, you can still make money without them, and don't feel like you're being left behind. There are plenty of ways to make money investing with a good, high-quality, diversified portfolio, tailored to your goals, your risk tolerance, all the stuff that I talk about all the time, all the stuff that we do on the show. Don't feel like you need to run out and go find the hot manager, because more often than not, if you're reading about him as being a hot manager, by the time you invest, he will no longer be hot. Okay, well, that brings us to our second break. When we come back, I think we'll talk a little bit about how to pick a financial advisor.